Welcome back to the Deep Dive, where we take a stack of source material, articles, and research,
Right.
and we try to distill it all down into the essential knowledge you need.
Right, helping you navigate the markets, the news, and, well, the world, without drowning in all the details.
Today, we are strapping in for a massive deep dive into a corporation whose history, it really reads like a high-stakes corporate thriller.
We're talking about Constellation Energy Corporation, or CE.
Exactly. This is a company that, until very recently was kind of the definition of essential but unsexy infrastructure.
Mm-hmm.
And now it has become one of the most aggressive and strategically important power brokers in the entire American energy sector.
It's a huge shift.
We're tracing the journey of a firm that started with its roots deep in Baltimore, navigating this just constant, dizzying series of spin-offs, regulatory cliffs.
And surviving the immediate fallout of the 2008 financial collapse.
Which was just brutal. Its stock price plummeted over 50% in one day. And from there, failed multi-billion-dollar mergers, and ultimately emerging as this nuclear giant that is now pulling off, $26.6 billion acquisitions and securing contracts with behemoths like Microsoft.
It's a wild ride.
We had sources covering its dramatic corporate history, its very complex ownership structure, and a detailed breakdown of its truly massive energy portfolio.
And it is massive.
This company is now firmly entrenched as a NASDAQ 100 and S&P 500 component, which really just signifies its financial muscle. Our mission is to take this chaotic history and turn it into a clear, understandable narrative for you.
Yeah, to make sense of it all.
Okay, let's unpack this. We're going from humble Baltimore roots right up to the recent massive headlines, concerning nuclear restarts, and that acquisition that has just fundamentally reshaped the competitive energy market.
It truly is a remarkable story of financial and corporate resilience. When you look at Constellation, you're really looking at a perfect case study.
A case study of what, exactly?
Of how the U.S. power generation market has been deregulated and, restructured over the last 25 years.
So we're talking about a company that is absolutely foundational.
Foundational not just for providing power to millions, but for setting the pace for American nuclear operations and, increasingly, dictating terms in the high-demand data center market.
Okay, so let's set the scene. For you listening right now, what is Constellation Energy Corporation today?
Right now, it's an independent public American energy company, headquartered in Baltimore, Maryland.
Still in Baltimore.
Still in Baltimore. They operate primarily in power generation, but they also provide electric power, natural gas, and energy management services to about 2 million retail and commercial customers across the continental U.S.
So that's the side of the business most people might interact with.
That's the customer-facing side, yes.
But as you pointed out, the generation capacity and the financial scale are just staggering. Let's talk about the 2024 metrics, because they really define the scale of the powerhouse we are analyzing today.
Absolutely. The 2024 financial data, it gives us an undeniable picture of their market dominance. So the company is operating with U.S. $23.6 billion in total revenue.
That is a massive operational footprint.
A huge footprint. But what really grabs your attention is the profitability that's inherent in that scale. Their operating income stands at $4.35 billion.
Wow. And that level of operating income shows that they've mastered the efficiency of running these incredibly complex assets. It's not just about volume of sales. It's about the highly profitable nature of their core business, which is generation.
Precisely. And that profitability is what fuels their strategic future. They possess a total asset base of $52.9 billion.
$52.9 billion.
That massive balance sheet is the engine room that lets them absorb a financial shock, pursue these strategic, high-risk, high-reward nuclear projects, and critically manage multi-billion-dollar debt and acquisitions.
Like the Calpine deal we'll get into.
Exactly like the Calpine deal. And they're supported by a skilled workforce of 14,264 employees. This underscores that they are not just a utility, they are a critical national infrastructure asset, a major power broker.
That context is vital. So let's explicitly lay out our mission for this deep dive. We're answering 3 core questions, tracing the Constellation arc. First, how did the company navigate the choppy waters of financial collapse, failed deals, and the massive corporate movements of the Exelon merger and then the spinoff?
The whole roller coaster.
Second, what exactly does their huge and diverse energy portfolio look like across nuclear, fossil, hydro, wind, and solar? And, why is that mix so strategically valuable right now?
This is a key question.
And third, Why are they suddenly making massive, high-profile headlines with nuclear restarts, landing landmark contracts, and announcing these multi-billion-dollar acquisitions in late 2024 and early 2025?
Understanding that journey from local utility to near collapse to market dominator, that's the core of the Constellation story.
So let's start at the beginning. Back in Baltimore,
Back in Baltimore.
the story of Constellation Energy Group, which was the predecessor entity, is deeply rooted in the history of Baltimore, Maryland. We have to remember that before it became this national powerhouse, it really originated from a very traditional, very local utility structure.
That's right. The original foundation was the beloved local utility Baltimore Gas and Electric, or BGE.
Right.
In 1999, BGE created Constellation as a holding company. And this wasn't a random decision. It was a direct response to that sweeping trend of deregulation in the 90s and early 2000s.
So everyone was doing it.
Pretty much. Traditional utilities were being encouraged, sometimes even mandated, to structurally separate their regulated transmission and distribution.
Wires or pipes.
The wires and pipes, exactly, from their competitive power generation and energy marketing arms.
So Constellation Energy Group was essentially BGE's vehicle for expansion, for playing in those competitive energy markets outside of its safe, regulated home turf.
Exactly. And they acted quickly to expand that footprint. Even before the massive mergers of the later 2000s, Constellation Energy Group was an aggressive player. The sources indicate they were already operating more than 35 power plants scattered across 11 states.
Wow, 11 states right out of the gate.
They established a clear geographical presence in key energy hubs: Maryland, Pennsylvania, New York, West Virginia, and California. They were strategically building generation capacity where the market was competitive and, where demand was highest.
And that national expansion, it quickly led to some serious nuclear ambitions and a few early, very high-drama failed unions. They really went for the gold standard of energy generation right away.
Their commitment to nuclear was evident early on. The Unistar nuclear joint venture, formed in 2005 with the massive French nuclear firm Areva, showed this intent.
And their mission was pretty ambitious.
Oh, incredibly. To market the European pressurized reactor, or EPR technology in the U.S., this was Constellation signaling that they wanted to be leaders in the next generation of nuclear technology, not just operators of the existing fleet.
And 2005 also saw the start of the first major merger drama, the FPL Group saga.
Yes. In December 2005, FPL Group announced a huge acquisition of Constellation Energy, valued at $11 billion. This was a massive consolidation move at the time.
And FPL was serious about it.
Very serious. The level of commitment was clear. They intended to adopt the Constellation Energy name for the merged entity. This suggests they deeply valued Constellation's brand and, probably more importantly, their operational expertise in those competitive generation markets.
An $11 billion deal where the buyer adopts the seller's name. That almost never fails. But the sources confirm it did. Why?
The merger was canceled on October 25, 2006. And while the source material is a bit reserved on the exact internal corporate politics, the consensus really points towards significant friction.
Friction over what?
Regulatory approval and integration issues, especially surrounding Constellation's valuable but very complex nuclear assets.
So they just couldn't make it work.
Walking away from an $11 billion deal after you've planned to rename your entire company, that shows you that the strategic or regulatory hurdles were just insurmountable.
And this established a pattern for Constellation, didn't it?
It did, operating at the extreme high-stakes end of the energy M&A market.
That volatility leads us directly to the most dramatic period of their existence, the 2008 financial crisis, and this epic battle for control involving Warren Buffett's Berkshire Hathaway and EDF.
This is where Constellation's fate hung in the balance, tied not to a power plant outage, but to the global financial system itself.
And the critical flashpoint came on September 15, 2008.
The day Lehman Brothers collapsed, reports immediately surfaced linking Constellation's commodity trading operations and their financial exposure to Lehman.
And the market reaction was?
Instantaneous and brutal. The stock dropped a massive 56% in a single day.
56%.
In one day. The collapse was so swift and so severe that the New York Stock Exchange was forced to halt trading in Constellation's stock just to restore order. The next day saw even further plunges.
For a company focused on producing stable, essential power, this was an existential financial shock.
It demonstrated just how integrated the competitive energy trading business had become with the global financial system.
A 56% drop in a single day means total chaos. What was the immediate defensive response from the Baltimore headquarters?
They mobilized immediately. They hired two major investment banks, Morgan Stanley and UBS, to advise on strategic alternatives.
Which, in moments of crisis, is always a euphemism for.
We are seeking an immediate cash injection or a full buyout. They were trying to avoid insolvency and a fire sale of their most valuable assets.
And then, the legendary rescuer of American finance, Warren Buffett, stepped in.
Indeed. On September 17, 2008, a mere 48 hours after the Lehman shock and the stock halt, Constellation accepted a bailout offer. It was a $4.7 billion offer from MidAmerican Energy, which is a key subsidiary of Berkshire Hathaway.
This must have seemed like a stabilizing force.
It did. It provided capital and the implicit seal of approval from one of the world's most trusted investors. It looked like the crisis was averted.
But stepping back from the numbers, that stability, it only lasted a few months. The sources detail that the Buffett deal was ultimately canceled on December 17, 2008.
And in favor of a competing and actually slightly smaller offer.
Right, this is where the crucial strategic insight comes into play.
It is. Constellation accepted a $4.5 billion buyout from the French power giant Électricité de France, or EDF.
Now, you have to ask, why would they take $200 million less?
The answer lies in the nuclear business. EDF was already a partner in that Unistar nuclear venture. By aligning with EDF, Constellation ensured the stability and development of their core nuclear assets and ambitions.
So they were granting the French company significant influence, if not outright control, over those operations.
Exactly. This decision prioritized strategic, long-term nuclear alignment over the immediate maximum cash value.
That is the core takeaway there. Constellation was willing to sacrifice short-term financial gain to solidify the future of its massive nuclear fleet. That's a powerful indication of where their strategic focus truly lay.
It is. And as part of this aggressive restructuring and focus, they started shedding non-core assets. In 2009, they sold the majority of their London-based international commodities business to an affiliate of Goldman Sachs.
So they were streamlining, focusing domestically, and just ensuring operational stability after that near-death experience.
That's it exactly.
Having survived and stabilized under EDF's influence, the company then spent the next few years on aggressive strategic growth before its next major pivot, the massive merger with Exelon.
The period between 2010 and 2011 demonstrates Constellation was not resting. They were in acquisition mode, deliberately diversifying their energy mix and expanding their retail base.
Showing immense confidence after the 2008 debacle.
A ton of confidence. And they targeted both renewables and key fossil fuel assets.
Let's look at the specifics.
Okay, look at the specific transactions. In 2010, they secured the Criterion Wind Project in Maryland, adding 28 Clipper Liberty 2.5 megawatt wind turbines to their portfolio.
Just an immediate boost to their renewable profile.
An immediate boost.
Yeah.
And simultaneously, they made a massive play in the competitive Texas natural gas market. They acquired two 550-megawatt combined cycle facilities.
The Colorado Bend Energy Center and the Quail Run Energy Center.
Right. Adding 1,100 megawatts of flexible capacity for $365 million. Gaining a strategic foothold in Texas, with its famously deregulated and competitive market, was critical for future scale.
And they were relentless in pursuing the final consumer during this time, too.
They were. They quickly acquired competitive retail electricity providers like Startex Power and MX Energy, bringing approximately 500,000 retail customers under the Constellation banner.
And this dual strategy of controlling the massive generation assets and building a significant base of retail customers who need that power.
That's what allowed them to dictate terms in the competitive marketplace.
All of this growth set the stage for the union with Exelon, creating one of the largest power generators in U.S. history.
In April 2011, Exelon announced its intention to purchase Constellation Energy, a deal that closed in March 2012 for $7.9 billion. This was the consolidation of two colossal power generation empires, particularly merging their massive nuclear fleets.
And here is the crucial point for understanding the current company structure. The outcome of that 2012 merger was a separation between the regulated and competitive arms, even though they were under the same umbrella.
This is a key insight. When the merger finalized, the original BGE, the Baltimore Gas and Electric Utility, went under the umbrella of Exelon Utilities, the slow-growth regulated side.
The transmission and distribution.
Right. Constellation's competitive energy supply business, however, was rebranded as Constellation, an Exelon company.
So the Constellation name became synonymous with the high-risk, high-reward competitor generation and energy marketing business.
And this internal separation was really the blueprint for the current independent company.
It effectively put the generating power, the nuclear, the gas, the hydro fleet, into a distinct competitive entity. So that when the 2022 spinoff occurred, the new Constellation Energy Corporation was born, ready to operate aggressively in open markets, unburdened by the requirements of running a local regulated utility like BGE.
Precisely. They were basically incubated within Exelon, growing their capacity and integrating operations before being released back into the competitive market as an independent entity 10 years later, strategically optimized for generation and retail sales.
Shifting gears now, we need to understand exactly what Constellation controls today. And it's hard to overstate the importance of their nuclear fleet.
What's fascinating here is that Constellation's entire strategy hinges on its dominance in nuclear power. They are the United States' leading nuclear power plant operator,
And the numbers are?
generating over 19,000 megawatts.
19,000.
To put that in perspective, that single entity controls nearly 1/5 of the entire nuclear capacity in the United States.
Wow.
That is a staggering amount of firm, reliable, 247 carbon-free power flowing directly to the grid.
That 19,000 megawatt figure is pure baseload capacity. It defines the company's ability to guarantee continuous power, which is hugely valuable, especially as intermittent renewables like wind and solar grow.
It absolutely does. And if you look at the map, their assets show a strategic concentration around major population centers and highly competitive regional grids.
Like in Illinois.
We see the heavy concentration in Illinois, which is often called the nuclear belt of the Midwest.
Right.
Braidwood, Byron, Clinton, Dresden, LaSalle County, and Quad Cities. This cluster provides essential stability to the PJM interconnection and the MISO grids.
And their reach ensures stability throughout the Northeast as well.
Correct. In New York, they operate Ginna, James A. Fitzpatrick, and 9 Mile Point, which are crucial anchors for New York State's energy needs.
And Pennsylvania.
In Pennsylvania, they have Limerick, Peach Bottom, and 3 Mile Island. They also own Calvert Cliffs in Maryland, securing the Mid-Atlantic.
And beyond just majority ownership, they also have minority stakes.
Right. Their strategic approach is also visible in minority stakes, like at the Salem Nuclear Power Plant in New Jersey and the South Texas Nuclear Generating Station.
So what's the logic there?
This allows them to capitalize on the financial stability of those large assets without taking on all the operational risk and cost of being the sole owner. Their nuclear base is not just large, it is strategically placed and financially leveraged.
Okay, now let's pivot from their massive carbon-free baseload to their substantial and sometimes surprising fossil fuel footprint. For a company that markets itself around its nuclear dominance, the sheer size of their fossil portfolio, over 12,000 megawatts, is critical to understand.
This is where we understand how the modern grid works. Constellation owns and operates a fossil fuel portfolio generating more than 12,000 megawatts of power.
And that capacity is essential because
While nuclear provides base load, the floor of power demand, the fossil assets, predominantly natural gas, provide load-following capacity and peaking power. They can ramp up or down quickly to meet rapid fluctuations in demand or sudden drops in solar or wind output.
So these gas plants provide the flexibility that the nuclear plants, which are designed to run 247 at max output, simply cannot provide.
Yeah.
They're the shock absorbers for the grid.
Precisely. And the portfolio is deliberately diverse, spread across the Northeast, South, and even Canada. Let's look at some specific examples to illustrate this competitive advantage.
Okay.
The Texas facilities, Colorado Bend 2, Wolf Hollow 2, and Hanley generating stations are modern combined cycle gas turbine, or CCGT facilities.
Which are highly efficient.
Very efficient. They use the waste heat from one turbine to power a second one, making them economically competitive and often essential in the highly decentralized Texas market. They provide quick, reliable power for an extremely demanding, growing grid.
You also mentioned the Everett LNG facility in Massachusetts. That asset seems to serve a different, very specific strategic purpose.
It does. The acquisition of Everett in 2019 was a key strategic move for Northeast energy security. This facility handles liquefied natural gas imports.
So in the winter.
During peak winter demand, the ability to import and convert LNG to natural gas for fueling their power plants or supplying the residential market is invaluable. It helps Constellation hedge against pipeline capacity constraints that plague that region during cold snaps.
And what about the oil-based generating stations listed in Pennsylvania, Chester, Croydon, Delaware, Falls, and others? These sound like older, less efficient units.
They are. These facilities often operate as critical peaking units or emergency reserve capacity within the PJM market. They might sit idle most of the year, but when a heat wave hits or when an unexpected transmission line goes down, these units can be brought online very quickly.
So they guarantee resilience.
And for that resilience, they are compensated highly by the grid operators. This diversity is Constellation's insurance policy for grid stability in major metropolitan areas.
So their scale isn't just about generating power, it's about being a massive manager of energy commodities.
Absolutely. Beyond owning the physical assets, Constellation is one of the 10 largest natural gas marketers in the U.S.
How much are they moving?
They deliver approximately 730 billion cubic feet of natural gas annually. This means they are experts in trading, transport logistics, storage, and complex hedging strategies. They don't just consume gas, they manage the entire supply chain.
Which gives them a tremendous edge.
A huge edge in securing fuel supply for their own fleet and marketing it profitably to others.
Now let's look at their hydro and non-nuclear renewables. They have significant hydro assets.
They do. Hydropower provides stability that is second only to nuclear. Constellation generates 1,600 megawatts from two massive hydroelectric assets, both located in the mid-Atlantic.
The first is the Conoengo Dam in Maryland. That is a historic piece of infrastructure.
It's an immense asset providing continuous clean power to the region. The second, the Muddy Run Pump Storage Facility in Pennsylvania, is conceptually even more interesting.
Pump storage is essentially a giant battery.
A giant water-based battery. It consumes power, often excess nuclear or nighttime wind power, to pump water uphill into a reservoir. When power demand spikes, they release that water to generate electricity rapidly.
Which is invaluable.
Invaluable for market arbitrage and stabilizing the grid during sudden demand shifts.
Moving to wind and solar, what is the scale of their newer renewable generation capacity?
Their wind portfolio is substantial, comprising 27 wind projects in 10 states, totaling nearly 1,400 megawatts. This is a significant complement to their nuclear fleet, ensuring they can credibly position themselves as a supplier of low-carbon electricity across various markets.
On the solar side, the sources show a clear strategy focused on large-scale commercial and industrial deployments, often tied to long-term power purchase agreements, or PPAs, with major clients.
That C&I focus is key. They aren't just building solar farms, they are partnering with major energy users. Examples include the Antelope Valley Solar Ranch 1 in California, but also local projects like the 10-megawatt solar array near Ocean City, Maryland.
Which is projected to meet, 20% of the city's annual usage?
That's right. It highlights a commitment to tailored, large-scale solutions.
And there are a couple of landmark projects that really stand out.
Two landmark projects truly demonstrate their commitment to distributed generation solutions. The first was the rooftop array built for the Toys R Us distribution center in Flanders, New Jersey, which was, at the time, the largest of its kind ever constructed.
And second?
The second was the comprehensive project for the Tucson Unified School District, equipping 82 facilities with solar generation capacity that was estimated to cover 47% of the district's electricity needs.
And these contracts provide stable revenue streams anchored by large, reliable customers.
Exactly.
Finally, let's quickly touch on their technology and service verticals, which show they're investing in the nuts and bolts of energy infrastructure, maintenance, and future growth.
This is their institutional expertise, codified. Constellation Generation Solutions, or CGS, is their internal maintenance and technical services arm. Running 19,000 megawatts of nuclear capacity requires world-class maintenance protocols.
And CGS is designed to streamline that.
It streamlines work, execution, quality control, and safety across that highly sensitive fleet.
And then there's Constellation Power Labs.
Right, which dates all the way back to 1911. This subsidiary has become their primary calibrations and testing laboratory. Its 4 strategically located labs provide engineering and metrology services critical for the urgent demands of nuclear facilities, power grids, and their complex supply chains.
So it's a quiet but crucial competitive advantage.
It really is.
And their venture capital fund shows they're also looking far down the road.
Constellation Technology Ventures, or CTV, is actively investing in the next generation of energy infrastructure. Their portfolio examples like Proterra,
Electric buses,
ChargePoint,
charging infrastructure,
and Aqueon Energy for advanced storage show that Constellation wants to be integrated into the technologies that will define demand for their clean power in the future.
they're connecting the dots.
They are connecting the dots between their generated capacity and the end-use customer.
We've covered the history of survival and the current massive portfolio. Now we turn to Section 3, Constellation's second life as an independent entity since 2022. This period is defined by an aggressive expansion and a firm commitment to nuclear revival.
The current iteration of the company was born in 2022 when Exelon strategically split its business. The independent Constellation Energy Corporation was created by spinning off the power generation businesses from the regulated utility operations.
So to clarify that crucial distinction one more time, BGE, the original Baltimore utility, it stayed with Exelon.
Right, focusing on the regulated business, the stable distribution of power.
While the new independent Constellation received all the competitive generation assets.
The nuclear fleet, the gas plants, the hydro dams. This allowed the new Constellation to be far nimbler in pursuing competitive market opportunities and making aggressive capital investment decisions, unconstrained by the regulatory bureaucracy of the utility side.
They were unleashed.
They were!
And this newly independent structure is directly leading to massive headline news, particularly around the nuclear revival. Here's where it gets really interesting. Let's talk about 3 Mile Island.
The story of the 3 Mile Island, or TMI restart, is perhaps the clearest symbol of Constellation's renewed focus.
Right, while the site is infamous for the 1979 incident involving Unit 2.
Constellation owns the undamaged Unit 1 reactor. It had been retired for years, just sitting there as cold capacity.
But the massive, ever-increasing demand for secure, carbon-free power from the tech sector provided the catalyst for revival.
Exactly. In September 2024, Microsoft entered into a contract with Constellation specifically to restart Unit 1 at TMI.
And that's significant because
Microsoft, like other large tech companies, requires immense amounts of clean power to fuel its data centers. Nuclear is the only dispatchable, firm, zero-carbon source that can meet those massive loads 24 hours a day, 7 days a week.
So the contract basically provided the guaranteed revenue stream needed to justify the immense capital expenditure for the restart.
That's right.
But even with a corporate contract, the restart of such a symbolically significant site carries political risk. How did Constellation mitigate that?
The political significance cannot be overstated. Constellation successfully argued that reviving TMI Unit 1 was critical for national energy security and decarbonization goals.
And that argument worked.
It did. This resulted in the Trump administration announcing, in November 2025, a $1 billion federal loan to back the project.
Which signals a massive bipartisan political consensus that nuclear capacity, especially existing viable capacity, must be prioritized and financially supported.
And Constellation positioned themselves perfectly to benefit from this federal mandate.
And the TMI restart is just one part of a broader, more economical strategy to maximize their existing nuclear infrastructure.
Their broader strategy is what industry insiders call uprating. Instead of waiting a decade and spending $30 billion to build an entirely new nuclear plant,
which is politically and financially risky.
Very risky. Constellation is planning to upgrade other existing reactor plants to provide more power.
So what does that involve?
It involves significant engineering and regulatory work, but the return on investment is immediate and high. By investing millions in internal component upgrades, they can squeeze out an extra 50 or 100 megawatts of zero-carbon power from an already operational unit.
And this uprating strategy allows Constellation to add thousands of megawatts of new, clean baseload power to the grid, faster and cheaper than any other generation source.
That's the key.
If the nuclear strategy is maximizing their existing assets, the Calpine acquisition, announced in early 2025, is about rapidly expanding their portfolio with new asset classes and new market positions. This deal is massive. It changes the entire competitive landscape.
The Calpine acquisition, agreed to in January 2025, sent shockwaves across the market. Calpine is a major power provider specializing in highly efficient natural gas and uniquely geothermal power.
Let's talk scale again. This is one of the largest power generation acquisitions in recent history.
The headline value is $16.4 billion in cash and stock, but the full picture includes Calpine's existing debt, pushing the total enterprise value of the deal to $26.6 billion.
Which is an enormous leap for an independent company only 3 years post-spinoff.
It demonstrates Constellation's immense financial confidence and their ability to execute massive, complex M&A.
So this acquisition fundamentally changes the strategic balance of Constellation. While they champion zero-carbon nuclear, this acquisition brings in a huge fleet of gas-fired power plants. What's the strategic rationale for that apparent contradiction?
That is the essential conflict. and it shows Constellation prioritizing grid stability and market arbitrage. Calpine brings in a fleet of modern, highly efficient natural gas plants, often in fast-growth, competitive markets where Constellation wants deeper penetration.
So these plants are the perfect complement to nuclear baseload.
They're the perfect complement. They provide the necessary rapid response capacity or load-following capability that allows Constellation to maximize profitability in fluctuating markets. They are hedging against the intermittency of the growing renewable sector.
And what about the geothermal aspect?
Furthermore, Calpine brings geothermal capacity, which is firm, non-fossil, carbon-free power, something Constellation definitely wants more of.
It runs 247 like nuclear.
Runs 247 like nuclear, but is geographically diverse. The acquisition solidifies Constellation's ability to sell a full suite of power products, from zero-carbon baseload to rapid peaking power.
Given the sheer size, it's worth reminding you, the listener, that a deal of this magnitude isn't finalized overnight.
That's absolutely right. The purchase is subject to review and approval by various state and federal regulators, including potentially FERC and antitrust regulators, given the immediate consolidation of market share this creates.
But the intent is clear.
The intent signals Constellation's aggressive posture. They are done with playing it safe. They are aiming for market dominance.
And while they're maneuvering these massive generation deals, they haven't slowed down their retail expansion. They're still steadily acquiring competitive retail businesses to ensure they have a direct line to consumers who need their power.
The retail growth has been continuous and strategic. Even while owned by Exelon, Constellation was acquiring competitive businesses. In 2014, for instance, they acquired ETC Proliance Energy to boost their natural gas marketing and supply business.
The acquisition of Integre's energy services in 2014,
Right.
that was a game changer for their national footprint.
It was crucial. Industries was a large competitive retail electricity and natural gas subsidiary serving customers across 22 states. This massively increased Constellation's geographic reach and customer base.
Giving them a national scale for retail energy supply.
Exactly. The ability to sell power generated in Texas to customers in the Northeast, for instance.
And then in 2016.
Then in 2016, they completed the acquisition of the competitive retail business from Con Edison Solutions. This single transaction added over 560,000 customers, commercial, industrial, and residential.
And that translates to
15 terawatt hours of electricity and 1 billion cubic feet of natural gas annually. This steady, calculated accumulation of retail contracts provides a massive, stable demand base that acts as a secure anchor for the power produced by their generation fleet.
So the post-Exelon Constellation is a company operating on 3 simultaneous high-growth tracks, leveraging unrivaled nuclear assets, aggressively consolidating the competitive retail market, and making strategic multi-billion-dollar acquisitions like Calpine.
That's the playbook. Before we wrap up, we should briefly touch on Constellation's deep ties to its original community. For all its global dealings and national scale, Constellation remains fundamentally rooted in Baltimore, Maryland, and that legacy really informs their corporate responsibility.
And we see that local commitment reflected clearly in their substantial philanthropic activities.
Yes. The sources highlight that in 2017, Constellation ranked second in local corporate giving among all Baltimore-based companies, donating $7.1 million that year.
Which is a significant investment back into the local community that gave rise to the company.
A huge investment. And what's important is the focus of that giving, providing grants to local schools that implement education programs promoting science and technology.
So this isn't random philanthropy.
Not at all. It's a strategic investment in the future of their business. As a high-tech energy producer, they need a continuous pipeline of talent engineers, physicists, skilled technicians to run those complex nuclear and gas facilities.
So investing in STEM education locally secures that pipeline.
It does.
They also maintain a unique historical connection to the city's infrastructure and development.
This is a wonderful historical footnote. Constellation owns the historical archives of the Baltimore Gas and Electric Company and its predecessors, reaching all the way back to the Gaslight Company of Baltimore, established in the 1800s.
Wow. We are talking about a massive historical collection that charts the energy development of the entire region.
It is vast. The Baltimore Gas and Electric Company's photographic collection alone consists of approximately 250,000 prints and negatives organized in more than 50,000 series.
And these archives aren't just sitting in a corporate basement.
No, they're carefully held and maintained by the Baltimore Museum of Industry. It means Constellation holds the actual history, the visual and textual record of how Baltimore and the surrounding Mid-Atlantic region developed.
Showing the deep responsibility that comes with operating critical infrastructure that spans centuries.
It really does.
This deep dive has truly charted a chaotic yet ultimately successful corporate trajectory.
It really has.
We traced Constellation from its origin as a local utilities holding company, surviving the brutal volatility of the 2008 crash by prioritizing nuclear continuity over a larger cash offer from Buffett.
Merging with Exelon, and finally emerging in 2022 as an independent, nuclear-focused giant.
In just the last few years, we've seen them capitalize on the demand for firm, clean power, making massive multi-billion-dollar deals like the $26.6 billion Calpine acquisition.
And securing landmark nuclear contracts like the Microsoft TMI restart.
So what does this all mean? This company is aggressively leveraging its unrivaled nuclear baseload capacity, its guaranteed carbon-free power, and strategically combining it with the most efficient, flexible natural gas generation available via the Calpine deal.
Right.
They're essentially positioning themselves as the comprehensive powerhouse for a grid that needs to be both zero carbon and resilient, betting that reliability and dispatchability will be the most profitable energy attributes for the next decade.
And if we connect this to the bigger picture, Constellation's strategic expansion, focusing intensely on upgrading existing nuclear plants and restarting retired units, it highlights the national imperative to find reliable, firm, carbon-free baseload power that can operate alongside variable generation like wind and solar.
So they're the primary vehicle for that strategy.
They are the primary vehicle for the U.S. strategy of keeping the lights on while decarbonizing the economy.
And their inclusion on financial indices like the NASDAQ 100 and S&P 500, that's really significant.
It is. It underscores that nuclear and generation capacity is now viewed as high-tech, high-growth essential infrastructure critical to the future digital economy.
So let's leave our listeners with a final thought.
Given the enormous scale of the Calpine acquisition, adding massive natural gas capacity to their dominant nuclear portfolio, you might consider this. Constellation is now the undisputed leader in both dispatchable zero-carbon power and flexible thermal generation.
A powerhouse in both.
How will the market's demand for clean energy and the push for political support for nuclear ultimately force Constellation to justify this complex portfolio balance? And what innovative technology or regulatory mechanisms must they deploy to convince the public and the policymakers that their combined gas and nuclear fleet is the necessary optimized transition tool for America's energy future?